Good morning and welcome to this Wednesday, March 30th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we do show futures down a little bit this morning. We've been in quite an uptrend of late, but we are showing futures as of about 10 minutes ago. Dow Futures are down about 119, S&P down 18.5, Nasdaq Futures down 96. Interesting day ahead. They're all interesting, of course, but after breaking above 4,600 on the S&P 500, it's going to be kind of interesting to see if we hold the support level. Now that we've broken out above that double top from early February, be interesting to see if on any pullback, we were able to hold on to that level. And, I think we'd be okay on the S&P 500 down anywhere from maybe 0.75% to 1%, somewhere in that range. If we fall below that and we fail to hold the breakout, it wouldn't necessarily mean that a lot of selling is going to pick back up again, but it could point to a possible 20-day EMA test. So that's something that we can kind of watch for today. As we head into the end of the month and into the beginning of April, of course, anytime we go into the beginning of a month, we start thinking about new money coming in. And normally the end of the month tends to be pretty bullish as portfolio managers prepare for that. You may have heard of window dressing, things like that, where portfolio managers will get in at the end of a month and especially a quarter, because a lot of times their holdings are reported at the end of a quarter, and they look like geniuses if they get in, even though their performance may not be great. If you're looking at their performance and you're wondering how many energy stocks they hold, for instance, because energy's been strong, sometimes they'll window dress by buying into stocks that have been really strong, and so it makes their portfolio appear as though they've got all these strong companies and winners. Anyhow, that's what we have in terms of maybe the money flows and the way the market normally works. That doesn't mean the market goes up every month at the end of the month and every month at the beginning of the month, but it is a tendency over the last 70 years that as a trader especially, you need to be aware of. All right. Well, we got a lot to go over. So before we get into any of that, let me go ahead and take you over to Earnings Beats. For those of you who are new to Earnings Beats, if you go over to our website, earningsbeats.com, just simply scroll down. We've got a free newsletter. I always like to start off, make sure everybody that is new is aware of our Earnings Beats Digest newsletter. It's free, no credit card required. You can unsubscribe at any time. Name, email address, that's all it takes. Hit that subscribe button. We'll make sure we get you set up. Monday, Wednesday, and Friday, that's when these come out. This morning, I had one, talked about Chipotle. Chipotle has been a stock that over the years has been a very, very strong performer. Well, except maybe for back, 2016 or 2017? I don't know, whenever they had the issues. What was it, the E. coli or that wasn't a great time for Chipotle. But outside of that, Chipotle has been a leader in the restaurant group. Restaurants have not been very strong, but Chipotle starting to show some leadership. And that was the whole idea behind the EB Digest this morning, was just to talk a little bit about the renewed strength, a little bit of the renewed strength that we've been seeing in Chipotle. We're getting close to a key resistance zone and area. And so I just wanted to point it out and just make sure that folks are aware of it. When you get a former leader that's starting to regain some strength, it's probably a good idea to at least be aware of it. Anyhow, those are the types of things that we do with the EB Digest. Love to have you if you haven't already subscribed. Also, if you are a part of this and we have any kind of free events, we always reach out. Make sure we reach out to our EB Digest community, send a link so that you can come in for your viewing pleasure. Tonight, this afternoon, 4:30 p.m. Eastern Standard Time, we do have an event coming up. I want to talk about the resumption of a secular bull market and what that looks like. If you've been a fan or if you're a member of Earnings Beats, back at the beginning of the year, I was talking about the first quarter, especially being rough. Well, the quarter's about to end. It was rough, but we're starting to strengthen back a little bit here. And is this the end? Is that the end of the weakness? Well, we'll talk a little bit about how these secular bull markets resume and some of the things you should be looking for, the leadership. That's really probably the most critical part. Where is Wall Street putting their money. Just to give you an example, I looked back at where we were on March 14th, which is the recent bottom that we had, and then look to see where we climbed to as of yesterday's close. And I did that across our major indices and across our sectors. And the Nasdaq over this period, this 10 or 11 day period now, the Nasdaq has been up 16.2%. S&P 500 is up 10.99%. And the Dow Jones is up 7.13%. It's good because we want the more aggressive Nasdaq leading. And the Nasdaq almost always leads when the market's going up. Is it great? I wouldn't say it's great. During secular bull markets, the Nasdaq tends to outperform the S&P 500 by a pretty significant margin. And while this is a decent margin, it's probably not as great as I would have liked to have seen during this rally. If you look at sectors, the groups that you would expect, we've got consumer discretionary up 17%. That's the leading sector over the last 11 days. Technology, 15.85%. Communication services, 11.27%. So the three aggressive sectors are leading this rally. So that's good news, but they underperformed so badly that, when I look at it, I'm not sure if it's more of a short-term little bounce or if it's really something that's going to drive us to all-time highs. I believe we're probably going to consolidate. I'll look at some more of this in just a couple of minutes. But anyway, if you are interested in coming to this event tonight, it's free, but you need to be a trial member. So you will need to give us a credit card. That's how we can get you set up in our system. But it'll start at 4:30, probably last for an hour and 15 minutes, something like that. And just going over, well, I mean, you can read about it. I'm not going to talk about it anymore, but just go to our web page and click on the link. You'll see this sitting right here on the front page. And then you can read a little bit more about it and register if you'd like to attend later today. All right. Dow Jones Industrial yesterday up 338 points. S&P 500 up 56. Nasdaq up 265 points. So on a relative basis, the Nasdaq, again, your leader. Now you can see the S&P clearly breaking above that double top in February. The Dow slightly below it. The Nasdaq also slightly above. So we are getting moves back up above some key levels. The AD lines look great. I mean, this to me bodes very well for the down the road. If you're asking me where we're going to be a year from now versus now, I say higher. And I feel really strongly about that. We're going to be higher in a year. That's my opinion, but I feel really strongly about my opinion. Market's not going down, in my opinion, over long term. This is not, and I've said it all along, this is not a secular bear market. It is a cyclical bear market. And it doesn't end until we break to a new all-time high, by the way. So just because, I mean, in hindsight, you can always go back and pinpoint the bottom, but we don't know if the bottom's in right now. So you don't know for sure that the bottom is in until you set a new high. Then the bottom's in. So right now, everybody's kind of speculating, is that the bottom? Is it not the bottom? I think with these breakouts yesterday, I'm feeling pretty strongly that we will not see a move back down below the lows we saw at the end of February on the S&P. And if we do, I think it'll be a head fake. Just based on the way everything is trading, I don't know if the volatility and all of the sideways action, the back and forth, blah, blah, blah. I don't know if all that's out of the way yet. We've got the summertime coming up. I think earnings season will tell us a little bit more. Are companies going to be lowering their forecast going forward? And are we getting hits that hit, taking more hits to the downside? I would be really surprised, and I'm pretty bullish. I'd be really surprised if this just keeps rallying and we go up to an all-time high. I just don't think it's going to do that. But at this point, based on the way the market's rebounded and the strength that I've seen, I don't think we go back down below those lows. Nothing meaningful. I don't see 3,500. Let's put it that way. Could we go down just below 4,100 and scare everyone? Sure. I mean, the market does that quite often. But I would be ruling out, in my opinion, I would be ruling out a major, really deep sell-off on the S&P 500 at this point. Mid caps up 56, more than 2%. Small caps up 2.4%. So there's your winner on a relative basis yesterday. Small caps breaking back out above 1350. You can see the double bottom here, came back up, had a double top there. And now we're Not only did we break above that, we went back down, held that 20-day moving average and broke to a new high. That right there is bullish, very, very bullish technical behavior. When you break through resistance, fall back, lose that support area, hold the 20-day, and then break out again to a new high. Really good action there. Real estate leading the action yesterday, up nearly 3%. Technology, another good day, more than 2%. Communication services, 1 3/4. Same goes for discretionary. Energy, the laggard. And if you notice the group that hasn't been really performing well over the course of the last couple of weeks, it's been energy. And when I did this exercise of looking at the different sector performance from the 14th to the 29th during this rally, as you might expect, energy was last. So 11th out of 11 groups, 3.74% it's up during this period, while the Nasdaq's up 16%, the S&P's up 11%. So definitely some relative hit, a relative hit being taken by the energy group. All right, moving on to the 10-year Treasury yield. Let's get an update, make sure we got the latest here. 241, so we're up almost 1 basis point today. Pretty rough day yesterday. We were up at 250 at the open, finished at 240. So a little bit of a reversal in the yields. Of course, that means money was simply rotating back into bonds. So when the yield's going down, means bond prices are going up. Always a 100% inverse correlation there, always. So if you see the yield down, that means bonds are being bought. If you see the yield up, bonds are being sold. Always that relationship. So anyway, here we're coming back down off the high. So we're seeing money rotate a little bit back into the 10-year Treasury yield. And as we did that, you know, maybe, or as we're doing that, that could be a culprit for maybe a little bit of selling in stocks. I mean, where's the money coming from that's going into the bond market, right? It could be new money, could be money on the sidelines, but also could be money coming back out of the stock market because the stock market's made such a big run. Now, when I look at the S&P 500, you know, I'm going to pull up a 5-day chart here. And actually, let's go back a little bit further than this. Let's go back 15 days. That way we'll cover the entire uptrend. If you look at this uptrend, I mean, is this nothing more than a series of higher highs and higher lows? I mean, that's what it looks like to me. Higher highs, higher lows every single day, except right here on March 23rd. Every other day, higher highs and higher lows. Now, the one day we had a down day was after we had a gap up and a move higher. We came back down, but we never went back down really below that prior day's low. So we just maybe took a little bit bigger leap and then we pulled back a little bit. Well, if you notice, we did the same thing yesterday. We had that gap up and then we closed strong. So we had another little bit bigger leap. So I wouldn't be surprised if we come down and hesitate back. Remember the breakout level. Let's look at the 3-month, 15-minute chart here. So here's your double top on the S&P 500. This was back earlier in February. And by the way, it's a 3-month chart. And every one of these candles is 15 minutes. That's why you can't really see what's going on in the candles. But the only thing I wanted to point out is this area where we broke out from. So just under 4,600 and then maybe 4,580, something like that. That's your double top. So if we were to go back down and just kind of consolidate, I'm going to say, let's look at that gap support. Gap support would be 45.75. So I think as long as we hold above 45.75, I think the short-term trend remains higher. So that could send us down 56 on the S&P, which is just a little over 1%. And as long as that gap support holds, I'm going to be thinking we're still in this uptrend. Now, if it doesn't hold, then I think that's when it starts to open us up to some other possibilities. To the downside, I think if you lose gap support, you've got the 50-hour SMA, which is down at 45.16. So that's a little over 100 points from here. We've had a negative divergence, by the way, for a while. We have yet to reset. We haven't gone down to the 50. We haven't gone back to the 0 line. And as we go higher, we still have this lower hourly PPO reading. So a 50-hour test wouldn't be out of the question if we fail to hold the gap support. That's where I think we're headed next. So those would be the two key short-term levels. In addition, if we get to the daily chart, the 20-day moving average would then be your third key area of support. And that would be currently at 44.37. So that would be down almost 200 points from where we are. We've gone up so much. There's a lot of room back to the 20-day. And that is normally an area where you will get a test. So I would be at least thinking about the possibilities. If we start to roll over, these are some of the areas where we could be looking. Also, remember that was the weakness where we gapped up from that one day where I said we had some weakness. That was at 44, close to 44.50. That's down pretty close to the 20-day EMA. Now, one thing I wrote about yesterday in the daily market report to members was the fact that we now have what could be a rising upsloping neckline. So we got this uptrend, and then an inverse head and shoulder pattern is always a possibility. Left shoulder, neckline, head, right side of the neckline, which is now upsloping, and then a pullback to an upsloping right shoulder. That would be a very bullish pattern that, if broken, would send us to a measurement that's well above the all-time high. So there are definitely bullish patterns in play here. What I think we could be looking at is more of what we saw in 2015 and 2016. So I'm going to bring up that chart. Let's go all the way back to 2014, middle of the year, and then go to 2017, middle of the year. So we'll do a 3-year chart here. Here we saw the big drop, and it looked like, okay, this was going to be a cyclical bear market. I mean, technically, we never quite reached it, because from the high down to the low, from this high over here, I'm not going to have it exact, but I'll be pretty close. Something like that. So we were down about 15% on the S&P 500, but you could see it was a pretty rough 6-8 month period. We took the big drop. Notice we came back up here. We got back through the 20, went back, almost through the 50, got up close to the 50, pulled back, put in a double top, and then we made one move back up, got almost to the high, and then we went back down for one more low. And look how this low went just a little bit below these other lows, just a few percent. And so we didn't quite get to 20%. I mean, from here, so we were at 15%. Here, we were down about 12.5%. Then we did the bounce, and then we went down another 2.5%, something like that, to get to that ultimate low. And that's when we ended up taking off. So that's why at this point, we can't really say that the rally we're having, we can't call off the cyclical bear market until we take out that prior high, because see what we did here? We came back up, got very close to that prior high, and then we went back down one more time. That period of, you call it a bear market, call it whatever you want, didn't quite hit the 20% threshold, but it was a rough period for a period of time, and it never ends until you drag this all the way out over here and you get this breakout. To me, that's when it ends, because at that point, you're at an all-time high. How can you claim you're still in a bear market if you're trading in an all-time high? You can't. So that ended that period right there. And then later on, you see we actually had another head fake before we ended up going back higher. But I wouldn't be surprised if what we're looking at this summer is similar. Nothing's ever the same, but just maybe some sideways consolidation, because we still have a lot of issues to get through. I still think there could be a scare with the recession. I mean, I don't know. We'll see, how that goes, and how things develop. One problem with making a call right now that we're in a recession is that, unemployment is so low. I mean, we had a jobless recovery, but can we have a full job recession? I don't know. That seems kind of weird to me. So, that's just one thing to consider. I mean, the employment is just one part We did get the ADP employment. I forgot to mention earlier, we did get the ADP employment report out this morning. And that's for March jobs. And the estimate was for 438,000. We came in at 455,000. So no disappointment there, slightly above expectations. Also, February, the 475 number was revised higher to 486,000. So it wasn't a bad report. Now, of course, everybody looks more toward the non-farm payrolls, which comes out on Friday, but we're not seeing signs at this point of a potential recession. So at least not on the employment side. I am seeing it in terms of sentiment. The Michigan consumer sentiment's been going down for a year. That is a pretty good leading indicator of a recession. So that's something maybe to keep in mind. But, this Friday, we're only expecting 155,000 jobs. So I think the bar is set pretty low. Last month was 678,000. So we'll see how it all goes. But anyway, this was just looking back at 2015, 2016. And you can see the low that was set here in 2014. We went back down and tested it multiple times. I don't know, if that's how this is going to set up. But because of the strength, the renewed strength we're seeing now, it just kind of reminds me of this period here where we had a double bottom and then we broke out. And then if we pull up the S&P 500 now, here we come down to this low. We have a double bottom. Now we're coming back up. We're breaking out above this high. It just kind of has that feel to it. They had a prior low over here, another low over here. I mean, all of this is somewhat in the same ballpark. So do we go up a little bit further and then fail, kind of like we did in 2015, and then back down one more time over the summer? I guess it's anybody's guess. With the volatility index still up high, and I would be careful if this starts to move again. I mean, we got down to 1890 on the close yesterday. That's great news. So the VIX has been coming down. I would love to see this VIX get back down to about 10. We would be in the midst of a pretty solid bull market when the VIX is at 10. And if you wonder, well, is that a sign of complacency? Well, yeah, but that's what a bull market is. I mean, bull market is overbought, remains overbought for a long period of time. So I don't look at VIX readings down at 10 as a topping signal. I mean, normally when the market tops, that's where the VIX is, but the VIX can remain in that area for a long time. So if you're just constantly saying the market's topping because the VIX is low, that can be just a process of futility. I mean, you just sit there and never be in the market. So you got to be careful about that. More volatility and especially the equity only put call ratio do a much better job of helping us during times of weakness and panic. When the market's panicking, they really are strong in helping us identify bottoms. And if you look at the S&P 500 when we bottomed, look at when the VIX hit the upper 30s. I mean, the upper 30s is a pretty high level on the VIX. Historically, when you're up in that area, you're looking for a market bottom. The February bottom, the January bottom, the February bottom, and then the March retest, all of them occurred with the VIX up in that 37, 38, 39 area. Okay, quick look at a couple of groups, software and semiconductors. These are two groups that obviously are big and very important to technology and very important to the market overall. We've had a nice run here on software, so don't get me wrong, this is really nice. We're getting back up close to that February high. Be nice to see a breakout. But on a relative basis, all the relative weakness we've seen, I really want to see a relative breakout. So the absolute strength is nice. The market's going up. Software, which had been beaten up like a drum, it was one of the worst performing, might have been the worst performing sector over this 3 or 4 month period. If it wasn't the worst one, it was probably second worst. So the group was due for a bounce. So it bounced. On a relative basis, has it really turned the corner? I don't think it has yet. So there's so many mixed signals in the market. I mean, if software was starting to take off on a relative basis, I would be thinking much more bullish thoughts. If sentiment, if the equity only put call ratio wasn't sitting right back down at 0.45 again, which is what's been marking tops, if it wasn't quite so bullish, then I might be a little bit more bullish the market. But there are still issues that make it really difficult to just want to put, go all in on the long side. So I think what you do is you respect the uptrend, but you prepare for another retest of a bottom. I think that's the only way you can play this market. So you're okay as long as the price action in wherever you're trading remains above the 20. We're getting the golden crosses. A lot of golden crosses have already occurred. Some are just now occurring. So when you got price action above the 20 and the 20s above the 50, honestly, I don't think that's a great time in a secular bull market to be thinking about shorting. But I think given everything we've been through so far and some of the signs that still suggest that, hey, we could have some volatility and some turbulence ahead, I just think you need to respect these key areas on pullbacks. And not everything has gone straight up. I mean, what's Apple been up 11 days in a row? Not everything's up 11 days in a row. In Tuesday's DMR, or Monday's EMR, today's Wednesday, Monday's daily market report to members, I showed a chart of Lowe's. Of course, it's not in software, it's home improvement. But Lowe's, if you looked at Lowe's, look at it, I mean, it hit support. So while a lot of stocks are going up, not every stock is going up. Lowe's was going down for 5 days in a row, hit a very key support level. If you go across right here, 210 was very significant resistance. We broke out, 210 holds the support. And right here in the Monday DMR, I talked about Lowe's printing a hammer right at that support level. So you don't always have to chase moves in other areas. You can be looking for leading stocks. And if you look at Lowe's, by the way, even though the group has not been great, look at Lowe's right here relative to its home improvement peers. A couple of weeks ago, it was at a 52-week relative high. You look at the chart and you see a downtrend, but what the relative strength tells you is what's going on beneath the surface. Sure, Lowe's is going down, but it's mostly going down because its group is dragging it down. I mean, as we were moving down to this new low, we got an AD line that's starting to move to a new high, or at least a 3-4 month high, and relative strength in the stock. And you're getting it at support. So there are always opportunities on the long side. You don't have to chase Apple after it's been up 11 days in a row. Look for areas, the other one, I'll go ahead and pull this one up. And then I'll go ahead and give you one more. And why don't we just call it quits with that? We'll actually end a little early today. So Lowe's was the first of the three you must see. Here's Chipotle. So Chipotle I mentioned, and what I'm liking here about Chipotle is look at the, how it was trending lower versus restaurants. And then it comes up, looks like it's rolling back over again, then comes up again, sets a new high. So now it's starting to show signs of trending higher versus restaurants. It also has a double bottom in right here at 1300. So if it clears this high in between the two, that would measure up another 300 points to me. We're right on the, right on the doorstep. And that's what I wanted to mention in the EBD this morning, was that this is a stock that, on the surface, you might look at it, you might not get too excited. But if you look back at this, let's go weekly for the last 5 years. This is a really nice restaurant stock. Look at the relative strength of CMG versus restaurants. It's been going up for 5 years. So off of this move to the downside, it's now starting to turn back up again. It's showing leadership. It's gone through a period of weakness. Look what happens in the past when it goes through periods of weakness. After it goes through periods of weakness, it delivers back to the upside. So these are the types of stocks, leadership stocks, that you should be looking at if the bull market resumes. And that's, again, what I'm going to be talking about later after the market closes today. The last one I'll show you is a stock I've been mentioning. I actually bought this on a breakout. I've talked about it for the last, maybe 2 or 3 shows, I think. But this was a stock that was moving lower, had been going sideways for a while, kept going up, trying to get through 114, couldn't do it. And the last 2 days, it's broken out. The volume's starting to pick back up again. Look at the AD line, very, very strong AD line, setting new 52-week highs. So that just tells me that even though price action was going lower, I think Wall Street was actually accumulating on that move to the downside. And you do that with these gap downs and these hollow candles. Look at some of these big hollow candles. And then we'll have some gap downs, gap ups, gap downs, whatever. But bottom line is, as we're going down, we have to be finishing a lot of these days, especially the heavy volume days. We have to be finishing fairly strong in order for your AD line to continue to perform well. So EW looks really good. All right, let's get a quick look at the market and we'll wrap up. All right, Nasdaq down 55, S&P down 9, Dow down 57. Same old, same old. It seems like when we've had weakness, it's been in the morning, and then we tend to come back. I would just, again, as I mentioned earlier in the show, maybe watch that gap support level in the S&P 500 around 45.75 and the recent highs around 45.90. That would be an area in the short term, very short term, where I'd be looking for support. If we fall below that, then I think we open up some possibilities for another 1-2% pullback closer to the 20-day. All right, that's it for me. Appreciate everybody tuning in. Again, if you haven't already signed up for a trial, we'd love to have you. Go over to earningsbeats.com right here. Resumption of a secular bull market. Going to talk about it a lot more later today at 4:30. So if you want to join in, look at some of the areas I'm going to be looking at in terms of strength in the market as it resumes, what stocks within those groups are starting to show leadership like the ones I showed you today in the 3 you must see, then you'll want to come to this event tonight. It's a free 30-day trial. So you can check out our service, come to the event tonight, and at the end of the 30 days, we will remind you and let you know that your trial is expiring. We don't want you to renew if you're not interested in keeping the service. Anyhow, everybody have a great day. Be back later today. Happy trading.